Chris, how many questions do we expect in section A? Stella, how many questions do we expect in section A?
15.
15. Okay, with 2 marks. So question 1, um, it is from IS 33, which is the earnings per share. Of course, it seemed to be a challenge to most of the students, and I think you also failed it, Stella. Is that correct?
Yeah, felt it.
Okay. So for this revision purposes, I will only focus on the area set in this question, but of course there are other parts of the standard that can be examined. Key to note is you just have to focus on the type of issue that has been made by by the entity in that given period. And when you look at this question, they are telling us that M net profit for the year ended 31st December 2022 is 565. Of course, from the normal computation, for you to get basic earnings per share, you get your earnings, you divide by shares, right?
Yes.
And of course, that should be the profit after tax. Then you divide by the number of shares or weighted average number of shares during the period. It gets
Yes.
somehow tricky when now we have either new issues, which can be at a given value or at market value, or can be bonus what? Bonus issue.
Issue.
Yes. So what will happen is for this question that we are looking at, these guys made a bonus issue, right? And when it comes to bonus, it can be
Yes.
a bonus issue, it can be a rights issue, right? And for
Yes.
bonus issue, of course, it becomes very easy, and I'll focus on that today. Okay, so we should be required to compute a bonus fraction. But key to note, when it comes to bonus issue, it means we are not getting any financial contribution from the holders of the already existing what? Shares. But rather, we are just trying to increase more ownership to those guys. Is that correct?
Yes.
So, no more extra financial resources from the person who's going to receive our shares, but we're just giving them more what? More more shares into the business. What is important to note, we always have no change in the ownership of the business, but rather it is more of a change in number of available shares, but the proportion of ownership for each of the owners remains the same, because each of them will receive a similar what? They receive a similar fraction. Eh?
Yes.
All right. So what is key is for us to compute a bonus fraction, and you guys will tell me how we do that. But we can read through. Uh, the profit after tax is 565, which is okay. At the start of the year, M had 6 million shares in issue. On 1st September 2022, M made a bonus issue of 1 share for every 8 held. The question is, how do we get the bonus issue? I mean the bonus fraction, because that is important. Bonus fraction. Because it is the bonus fraction that we use to adjust the number of shares that now should be considered at year end. And remember, for bonus fraction, we assume that these shares existed even at the start of the what? Of the period. So how do we get the bonus fraction? Yes?
I think here where they said for every 8, you get 1 extra.
Okay.
I think it's 8
Okay, good.
plus 1
Correct.
over the 8 shares you get.
Divide by the 8. So our bonus fraction is 9 out of what? Out of 8.
8.
So that fraction will help us get what? It will help us get the number of shares that will be in issue at year end. Then for us to adjust the number of shares in issue at the start of the year, so that we can now adjust the comparative figure, we use the reciprocal of the bonus fraction. Is that correct?
Yes.
Okay. So can you get me the number of shares that should be existing at year end? So number of shares at year end. We just have to get those that existed at the start. Is that correct?
Yes. Times the fraction.
Then times the fraction. And how much do you get? Or how many shares do you get?
6,750,000.
6,750,000. So those are the number of shares. Okay. So what is going to be our basic EPS? Because they want the basic, right? So basic EPS would be, remember we said it is earnings, net profit, which is same as
Yes.
profit after tax, divided by the number of shares, right? So which is 56 what? 565 divided by
Divide by
the 67 what?
50.
6750. How much do you get?
50. 50. Um, it's 0.084.
84. Remember those are dollars, right? But our
Yes.
number is presented in cents. $1 has 100 cents. Is that correct?
Yes.
So you multiply that figure by 100. What do you get?
8.4.
8.4 cents. Now, first to get the comparative figure, we said what do we do? Remember they told us that there were no other share issues during the period. M reported the basic earnings per share for the year ended 31st December 2021 of 11.0 cents. So for comparative shares, for comparative EPS, we get the reported earnings per share times the reciprocal of what? Of the bonus fraction. Is that correct?
The bonus fraction. Yeah.
Yes. Would be now the reported EPS times the reciprocal, which is 9 out of 8. Is it 8 out of 9 reciprocal?
Yes, 8 out of 9.
And how much do you get?
Right. 9.8.
You get 9.8 cents. Chris, is the computation clear?
But that's what I had.
Are you sure? Why did I cross it now? Okay. Then you'd have scored, it was an error if you had 9.8 and then 8.4. I don't know how I picked it wrongly. Okay, so our answer is A for that case. Now, you realize that for this question, you would take some time. Is that correct?
Yeah.
But the examiner arranges the section or the paper in such a way that you can save time on other what? On other questions, as I will show you.
Actually, I got it wrong because I had 9 cents.
You see? So I didn't make any mistake.
I think what I did is I took that 6 million
Okay.
times the 9.8, I got the 6,750.
Mm.
Then for the weighted, I did now time apportionment because one was Jan to August.
Yeah, when it comes to bonus issues, I think you remember my statement. We assume that the bonus issue happened at the start of the year. You get? So for bonus issue, we don't do time apportionments.
Okay.
Yes, that is very, very critical. Chris, are you with us? Is Chris still on call? Stella, is Chris on call?
Yeah, yeah, I'm seeing him on call.
Okay, first we can proceed. Once he's here, I should be able to engage with him. Okay, so when it comes to this one, you got it right. Is that correct?
Yes, I did.
But for revision purposes, we can run through it. From
Yeah.
which part of the syllabus is the question? So that is important. Whenever we see acquired
It's
80%
goodwill.
and they want us to compute goodwill, which part of the syllabus?
It still confuse me.
Why, what confuses you?
Like, I have so many things in my head.
I know, but you know, once you know this, either the standard or the section of the paper, even your thought process can be guided, right? So this is from consolidation.
Yes. Okay. Ah, yeah.
It's consolidation,
Yeah.
which will be either it will be your question 31, It can be consolidation
Mm.
or single entity preparation of financial statements. Is that correct?
Yes.
All right. So once you see what is the value of goodwill, these are easy marks. You just have to remember what is the template for computing goodwill. Is that correct?
Yeah.
So can you remind me what is the template for computing goodwill?
It's consideration
We look at
plus
consideration.
the
Maybe
NCI.
since it is revision, what is the different form of consideration that we can have? It can be cash. Is that correct? It
Yes.
can be share for share. Is that correct?
Yes.
It can be contingent. Have you come across that one? It can be
No.
deferred. So you have to prepare for all of those. It can be they can pay you actual cash, or they can use their own shares,
Shares.
or you can buy an entity using cash. You can buy an entity using your own shares, where you give your own shares to the other guys that you're buying off. Now for contingent consideration, it means you pay some extra money subject to occurrence of some conditions.
Okay.
Maybe you agree that I'll pay 5 million, okay, contingent to increase in profits after tax of this much. So in the exam, they'll give you the fair value of that contingent consideration, right? So you add
Yes.
it. Now, have you come across deferred consideration?
No. That one I'm not done.
Yes, for deferred consideration, what will happen is you pay now, you pay cash and then agree to pay more cash after, let me say, given period of time. You pay them the 2 million today and tell them after 3 years I'll pay you extra 10M. You get it?
Okay. Yes.
So that is deferred. It will be paid after given period of time.
Yeah.
So from your understanding of such payments, what do you need to do? Any payments into the
You,
future?
you have to do the present value.
Yes, you have to discount that amount, right? So if the future value is 10 million, then you have to discount to present value and use that present value. Okay?
Yes.
So that
Yes.
is very important for you to first identify in my question which kind of consideration is given. Okay, so after consideration, what do we do? What do we add on?
The NCI.
We need the NCI share, right?
Yes.
Or fair value of the NCI. I'll use that, fair value of NCI. And when it comes to fair value of NCI, what are the available methods that we have? It can be fair value method, right? Fair
Yes.
value method, or what? Or proportionate, proportionate
Share.
share of what? Of net assets of the sub, right? Where if the NCI, for fair value method, you just get the percentage of the NCI times the number of shares of the subsidiary times the fair value of the shares, right?
Yes.
Then for proportionate share of net assets, you get the NCI percentage times the value of assets, yeah,
Times the
of the subsidiary. Is
of
that
the
correct?
subsidiary. Is that correct?
Yes.
I think there is some
I
background.
think there is some background.
There's an echo. I don't know why.
There's an echo.
Let me mute.
Let me check if it is okay. Yeah, you can keep unmuting when I ask, right? Though I need your interactions. I know why you have that background. Okay, so it can either be fair value method or proportionate share of net assets of the subsidiary. So it is also important to identify which method has been established. Of course, from this question, we should be able to see. They've told us that the fair value of the NCI is this. So here we are lucky. They want us to save time. They've already given us the fair value of what? The fair value of the NCI. So we just have to plug it there. Okay, can you tell me what next do we do? Of course, we'll have our total here. Stella?
Then you subtract the net assets.
Yes, we subtract or we can less net assets of subsidiary at acquisition, right? That should be very, very clear at acquisition date. Okay, can we now identify the considerations that we have? Of course, this would give you your goodwill, and if there is any impairment, you can less it from that goodwill. Is that correct?
Yes.
Okay. Then we can less impairment of goodwill. Then the end of the day, you will have your goodwill at year end. This is goodwill at acquisition, right? Goodwill at acquisition date. Okay. So from the question, they are telling us that Paula acquired 80% of 1 million equity shares in Stellar by way of a share exchange of 2 new shares in Paula for every 5 acquired in Stellar. So which kind of consideration is this, Stella? Stella, which consideration is that?
Share for share.
Yes, so they used a share for share exchange. Share for share exchange. I see there is no cash because they're just giving us now that the fair value of net assets. And what is the computation like for share for share? Of course, we get the number of shares that existed, which is 1 million, right?
Yes.
1 million. And since my answer is in millions, I will not is in this format, I will not truncate. So 1 million times, since I need to know how many shares I'm going to buy off, out of the 1 million I'm buying off 80%. So that gives me how much?
800,000.
800,000 shares. And how many shares am I going to give them from my own entity? They are telling me I'll give them 2 new shares for every 5, right? So what do? I multiply 2 out of 5. Is that correct? That for every 5 shares I will give these guys, and I'll get from these guys, I'll give them 2 of my own. Stella, are you able to follow up?
Yes, I am. I'm following.
Perfect. Now, what is the share value? The question that always disturbs students here is, which fair value do we use? Is it fair value of the subsidiary or fair value of shares of the parent?
Isn't it the one of the parent?
Yes, it should be one for the parent. Here you're lucky that they're telling you that Paula's share price was this. It was direct. They didn't give one for what? For the subsidiary. But in some questions, they give one for subsidiary also. They will tell you Paula's share price was 5.4 and Stella's share price was 8.0. So you shouldn't get confused. It is the shares of the parent, the share price of the parent that we use.
Okay.
So how much do we get here now?
That's 320,000.
320,000. Oh, that's
Oh, you
amazing.
multiplied by the 5.4. Okay. It's
Yes.
1,728,000.
17.
1,728,000.
Perfect. Do we have the fair value of the NCI? Yes. They didn't want us to compute, right? The 850.
Yeah.
So can you add for me the 2? This you can do on a side note. The
Okay.
computation, you ask for a plain paper in the exam, they will give it to you, so you can compute from there. So when you add the 2, how much do you get?
2,578,000.
So what is the net assets of the subsidiary? They are just too much. So they gave it to us as what?
Million.
As 2M.
2 million.
Oops. Here 2M. So what is our balance? Goodwill at acquisition? 578, right?
Yeah.
578. But they told us that in the year ended 31st March 2009, goodwill had been impaired by 200. Is that correct?
Yes.
And since they told, you see, what is the value of goodwill arising on the acquisition of Stella, okay, at 1st October 2x8. This is very important. This might be a tricky one because they're asking us for goodwill at what? Is it at year end or at acquisition?
At acquisition. Because the year ended 31st March 2x9.
The year ended at 31st March.
March 2x9.
So this is at acquisition, right?
Yes.
So it's not at year end. So our answer should be this. Is that correct?
Yes.
But remember, there are someone. Okay, if you remove impairment of 200, what would be the figure?
378.
378. Is it part of the options?
Yes.
So someone who's not sober would go ahead and give this, right? Because they've seen impairment. But the question is at 1st October 2x8, which is goodwill at acquisition. This one. So the answer is B. Confirm you got it right. I don't have visibility of what.
Yes, I did.
All right. Nice. So let me get question 3. Chris, are you here with us now?
He was on, but he has gone off.
He has gone off. Yeah, he told me he's going to sit next in September. That's why I think. With working class, you guys are on and off. You get busy and you first ignore other books. Okay, so
Even me,
even
I'm
you?
doing a job transition actually.
Oh,
I just want to see if I can sit in this. I'm doing a job transition.
from
I am leaving Total, so I don't know if they will. Then my new place will give me at least a week to read.
where are you joining?
I'm going to Oryx. I'm going to handle their credit control.
Orex. But anyway, maybe they came with a better offer. But I thought Total would be a better employer.
It's not what you think it
Sure.
is.
Okay.
Not what you think it is.
Wow.
Yeah.
Okay, that's good. Congratulations.
Thanks.
Yeah, but trust me, you didn't tell them that you're studying during your interviews because you always have to set your terms.
Of course, they do. They do. I haven't told them I'm sitting this in June.
Yes, so they should be able to give you that. Okay.
Week.
So can you, since I've run 1 and 2, can you run 3 and 4? So I can come back at 5 and 6. Because if you had Chris, you guys are supposed to be taking on these discussions and I just lead. So can you take me through this question? Question 3. Stella?
Just a minute. My thing is loading.
Okay. Chris, are you able to talk? It would have been a better experience when you are able to talk.
Yes, sir. Good evening, Ivan. Once again, I'm able to talk, but as I told you, have such topics. I'm just following up.
I didn't hear that.
Okay. As a married, haven't reached that side. I told those topics. So I'm just following up for more information and knowledge. By the time I reach there, I'm good to go.
Okay. So when we reach questions that are from simpler standards, you can be able to lead, right?
Exactly.
All right. Okay, Stella, are you ready?
Yes. Okay, so on 1st April to expert, Priya acquired 100% of Skylar for 6 million this. So at the date of acquisition fair value, these were the net assets, property 3.5, okay, 3,500, plant 2,200, intangibles 700, and then other net assets is 900. So they are saying, how should the purchase of Skylar be reflected in the consolidated statement of financial position? So we know that our total assets are 7.3. So what we shall do is we shall first calculate goodwill.
Yeah, it's because we are
So
seeing goodwill being referred to, yeah, right? They're talking about
yes,
goodwill here. So it forces us to compute goodwill, right? Because we don't
yes,
just compute it because we want, but because it has been mentioned in the what? In the question. So we need to know which one is the correct
questions.
Goodwill.
Will.
Because here they are saying record net assets and credit, that is okay. Remaining assets, that is okay. All right, so we need to compute our goodwill. And of course, the same template would work, right?
Yes.
Same thought process. What is different is how we treat the assets and then and then the cost of consideration, right?
Yes.
Okay, so from this question, which mode of consideration did these guys use?
Was cash.
These guys paid cash. So they paid cash of how much?
6 million.
And these guys paid what? They acquired what?
100%.
So do we have NCI?
No.
No, because of exam pressure, students can start asking, now where's the NCI fair value? Because of the pressure, which is understandable. So here we have no NCI.
Yes.
And here we used cash. Chris, are you able to follow now? Cash. At least the concept, yeah? 6
Yes, I
million.
am.
Okay. 6 million. So now we just have to look for the net assets of the subsidiary. How do we get it?
So the net assets were given to us as the 7.3.
Yeah, we have already the 7.3. Perfect. Of course, this would be 6M. No change. And this is the 7.3. So what do we get as our goodwill?
We get negative 1.3.
Perfect. Negative 1.3. What does that mean? We don't have an impairment. How do we call negative goodwill? Do you know it?
Please remind me.
Okay, this is called negative what? Negative goodwill, or we call it bargain purchase, right? Bargain purchase. Do you know what it means?
What it means?
Stella, do you know what bargain purchase means?
No.
Okay. You know, this kind of transaction is a deal transaction, right?
Yes.
So it means these guys made a better deal. And a better deal is you are buying a company that is worth 7.3, right? But you're only giving them how much?
6
million. You get? So it means you're getting so much of more than what you, so much of your money, of your investments. So it is more of I will not call it a profit. It is a gain that should go to P&L. You get me?
But they are paying you less than what your business is worth, I thought.
You remember, this is in the books of the parent, the guy who bought, right?
Oh, okay. Yeah, he has made up. Yeah.
He has made a gain. He paid them 6M
Yes.
for something worth
7. Okay.
So a negative goodwill is called a bargain purchase that goes to statement of profit or what?
Loss.
Or loss. But here the question is, you see, we have two options now. We have this 1.3. Are you seeing it?
Yes.
That is the only 1.3 that we have on our book. So we can ignore what? Now this is the elimination, yeah? So we don't have to think about C and D. So the question is, what would be the correct entry? We record our net assets at their fair values, which is okay. It is the same for what? For B. But for A, we say they are telling us that credit consolidated goodwill with 1.3, or we credit P&L with 1.3. What is the correct one?
Let me see. I think it's B. You record the net assets and you credit the P&L with a 1.3.
Correct. we say we agreed that for negative goodwill or bargain purchase, it is more of a good deal. So you
Yeah.
recognize a gain in your profit or loss.
Loss.
So our answer is B. Clear?
Yeah.
Any question for me?
No.
Okay, we go to question 4. So far we have our 6 marks. Okay, we move to question 4, then you also lead us through that. Let me see if this one is favoring Chris. Still consolidation. Okay, you can give it a try, Stella.
Okay. So it says which of the following should be accounted for using equity accounting in the consolidated financial statements. I think it's A.
You
Okay,
think
the different options are an investment of 40% of ordinary shares in a team. The remaining 60% of a team's shares are owned by Rowan PLC, who treats a team as a subsidiary. Then
uh-huh.
B, and
You see, we're going to we have to use elimination here. We have to use elimination.
okay,
Maybe I can first give you a brief overview here, because you had said that your answer is A, right?
yes,
But I know you're going to change your mind after looking at this discussion. So if the investment is between 0 to 20%, this is called just a mere financial what?
pardon?
If the investment in the entity, like you bought between 0 to 20% of the shareholding, that becomes a financial what? A financial asset, not so? It is just a mere investment. Okay? So we account for it as per IFRS 9. You get me?
Yes,
So if these guys bought 20% or 19 or 15 or 10 or 5, that is IFRS 9, financial assets.
yes,
Aha. Now if it is between 20% and 50%, do you know how we call this one? This is an associate. It's what? An associate.
associate.
But we use what? Equity accounting, which is IAS 28. You get me? But now when you look at all of these, they are all lying between this, right? They are all between
Yes,
20 and 50. So they all can't be
yes,
correct. So there is a trick somewhere. I'm going to show you. Okay. If you buy exactly 50%, that is a joint arrangement, right?
yes,
Joint arrangement, which can be either a joint operation, or joint venture. You have to know all these, eh? And with this, we use IFRS what? IFRS 11 to confirm, is it a joint venture or joint operation? If it is joint venture, we go ahead and use IAS 20 what? IAS 28.
great.
You get me? Now,
Yes,
if it is above 50%, more than 50%, now this becomes a subsidiary. You get me? A
subsidiary.
subsidiary. And so yeah, we use IFRS what? IFRS 10, yeah? Consolidation. We're also now talk about IFRS 3. We check if it is a business, if what we've acquired is a business, right? So this table is very important. But remember, there are other conditions, okay? Apart from the shareholding, okay? Other factors. Apart from the shareholding, okay? Someone can have can have less than 50%, right? But when they have other
Yes.
contractual rights, and so they can be allowed to consolidate. You get me? Here there is
Yes.
control. Here there is significant influence, not so? Significant
Mm.
influence. Then here is joint control. But the key concept is someone can have less than 50%. Now, like this one here, an investment of 40%. The remaining 60% of A shares are owned by R, who treats a team as a subsidiary. Now, if someone, okay, because in the question they want us to do what? Which of the following should be accounted for using equity accounting? Not so.
Yes.
Using equity accounting, where you have associate. They are telling us that these guys have 40% by a team. They own 40%. Then the remaining 60% is owned by
Someone else.
someone else who treats it as what? As a
Subsidiary.
subsidiary. You see, now you see this one here, eh? This one is not conclusive, because from associate accounting we look at other factors. Do you have board representation? Those are the other. That's the other factor, right? What else is the other factor
Yes.
for associate accounting? Yes. What is that? What is the other factor? Because that is very important. Apart from the percentages, when it comes to significant influence, you should have board representation.
You think the shareholding level?
Yes, which is between 20 and 50.
Participation in decisions.
Participation in decisions, yes. Of course, that is through board what? Board representation, not so.
Presentation. Yes.
So here we do not see any body representation. We come to the next one. An investment of 30% of shares in ESCA. Prima has one representative on who? On Axma's,
Akasma.
yes, on A's board. You see this kind of one representation?
Yeah.
So that would make that the correct answer, right?
Yes.
Okay. Then of course part C is an investment of 18%. This one would qualify to be what? Financial asset, right?
Yeah.
How about this one? An investment in 35% of non-voting irredeemable preference shares. Now this one is, you see, these are non-voting. Does it give you a right? No.
No.
So it cannot qualify. So the correct answer is the 30%, which is the
B.
voting rights, and then one board representation, which gives them significant influence rather than control.
Okay.
Is the concept
Okay.
clear?
Yes, it is.
All right. Since I've answered number 4, let me see what number 5 is about. I think I should just take a screenshot since it is quite big. I don't know why my screenshot is failing. Let me just copy it, then it will come after. Okay, so we have this. You can try out. All the first questions were from consolidation, which of course is good for revision purposes because you focus on that section of the syllabus that will also predominantly occupy section C, where you have to use the same concepts. Okay, so we have this. Can you try through?
Okay. On 1st July, Tazim received a cash grant of 500,000 towards the cost of an item of plant that was purchased on that date, on 1st July. So from the extracts, this is the financial position as of 31st March to X9. And non-current liabilities, which include the government grants, in 2X9 is 1,250, 2X8 is 1,100. Then the current liabilities in 2X9 is 850, and then 2X8 is 650. So it says, how would government grants be treated in a statement of cash flows for the year ended 31st March 2X9 in both operating activities to arrive at cash generated from operations and investing in activities sections. So what I did is I first took the total of both the liabilities, actually the total liabilities for each year.
And you got it right?
Yes.
Nice. Which standard is this?
This CGUs.
CGUs. Are you sure?
It has some PPE in it also.
These are government grants, right?
Yes, CGU. Oh no, it's different. It's different from grants that's cash generating.
Yes.
Okay.
This is IS20, right?
Confusion. Yes.
IS20, which is government grants, eh? But now they're also mixing it with the cash flows. Not so IS21, eh? Statement of what? Wait, is it? No, not IS21, it's IS7. You see? So it is a mix of government grants, which is IS20, and then IS7, cash flows. Statement of cash flows. Okay, so what was your approach?
Do you have a summary of these standards? Because the way they mix me up, I'm worried.
Okay, I'll send you just the name and the words, eh?
They really confuse you. Like you can have the concept, but you don't know where to apply what.
Yeah, of course for FR you don't need to know the names of the standards, eh? But as you advance to SBR, you need you need it. But I'll share with you a sample.
Okay, so I took the total for each year. So for 2X9, it was the current liabilities plus the non-current, giving me a total of 2,100. Then I also did the same thing for 2X8. I took the 1,100 plus the 650, giving me 1,750.
Okay.
So I took the change between both years, between 2X9 and 2X8. So I took the 2,100 minus the 1,750 to give me 350. So what I did is I calculated the income that we were going to receive.
Okay.
So it's closing is equal to opening plus the grant received minus the income. So our closing for the financial year 2X9 was 2,100, while our opening, of course, was the closing for 2X8, which was 1,750. Then plus the grant that we received up here where they say the government grant of 500,000
Okay.
was received. So I got my income as 150. So for me, it was that the grant increase the profit on the non-cash. So what I did is I deducted the 150
Nice.
while the 500 was an inflow.
Inflow. So end up with this.
Yes.
That's an amazing approach. But we can also try the double entry part of it. Of course, it shouldn't be very, very different from your interpretation. Okay?
Okay.
Alright, so they're telling us that on 1st July 2x8, of course, what we need to do is just to draw a T account for the grant. A T account for the grant what? For the grant income. These guys
Yeah.
received a grant of 500,000 towards the cost of an item of plant that was purchased on that date. Extracts from the statement of financial position. Anyway, this is from IS 20. This one is a capital grant, right? An asset grant rather than revenue grant. So,
Yes.
extracts from the statement of financial position are as below. We have non-current liabilities that have government grants of 1,200, and then current liabilities of government grants of 850. So these ones are due in the next 12 months. These ones are long term. Okay, how would government grants be accounted in the statement of cash flows for the year ended in both operating and investing? Key to note, when it comes to operating activities, okay, we need to know how much was contributed in our operating, how much was amortized, right? Because we see now these guys use the deferred income approach, right? They use the deferred income approach where an inflow is recognized under investing activities, of course, because these guys they are purchasing an item of assets or an asset item, and so with the deferred income approach, that amount goes to, it becomes deferred income, and then we start amortizing it. Is that correct? Then we start amortizing it. So what will happen? Of course, the 500 was very clear, but the question is, do we add it back or we deduct it? That would be now because we can see the 500 here and the 500 here. So A and C would not be our point of concern. So the issue is, how do we identify? I think I should use yellow. How do we identify which correct option to take? Of course, you have your own methodology and you got it right, but we can do this. Okay, so I can draw my T account. I'll do this. I can have the amount, a separator, amount, and description. Okay, so I have here the particulars. Have the amount. This is my splitter. I'll just do this. I have particulars, then amount. So this is our T account, and from your interpretation, what is our balance brought forward?
It's it was 1750.
1750. Are you sure? Balance brought forward of non-current liability, government grants.
Yes, sir. It's the 100.
It's the 100. Non-current
Yes.
liability, government grant. Meanwhile, here they are telling you that this is the opening balance of the deferred income, right?
Yes.
So it is 100. But we also need the balance brought forward for the current one, so that our deferred income is the total, the way what you did, right?
Yes.
So the balance brought forward of the current liabilities of government grant. But for easy understanding, we are trying to compute the opening balance of the deferred income from government grants. Clear?
Yes.
Now this side, what was the balance carried forward? Now because now this one is the closing balances, right? So what is the closing balance of the government grants? Or of the deferred income, which is balance,
Is it the total?
yes, balance carried forward. It would be the 250 and also balance carried forward of the 850, not so? But the
Yes.
question is, what is increasing our deferred income? Yes, what is increasing the deferred income?
Is it not the government grant?
Received, yeah?
Yes.
Which can be the same as deferred income from government grants. So this account is being increased by the grant received. So grant received of how much?
500.
Of 500. Did anything else increase the deferred income from government grants? No.
No.
So that would give us the total. So what is the total? Get me the total here.
So 100. 250.
Okay, this is 2
50.
250. I just want to make this easy for you. So this is deferred income from government what? Grants. The same here as opening balance, since they chose to use the deferred income approach. Because if it wasn't for the deferred income approach, they would have removed what? The 500 from the asset, from the value of the asset, not so? And so record a lower value. Okay, so it is 250, meaning that from the principles of balancing accounts, this should also be what? 250.
250.
So what is the difference?
Oh, 150.
150. You see? And the issue is this one is grant amortization, because we must amortize this 500. So it is the grant amortization, which is our balancing figure.
Okay.
Balancing. And you see now for it, since it is on the debit side of the deferred income account, it means it is being deducted, right?
Yes.
This one is added, and inflow, this one is reduced.
Yeah.
So it becomes very easy for you to identify what? Part D. But also with your creativity, you got the answer what? Right. But now when it comes to actual accounts, this would really appear in your books.
Okay.
Does it make sense?
Yes, it does.
But better you view it from the angle of deferred income,
Okay.
since these guys decided to use the deferred income approach to account for the government grants. If it was income approach, direct approach, they would have deducted,
Yes.
Okay, so we can move. Chris, any question? IS20, you should be done with it, Chris. So have you been able to follow through the discussion?
Yes, I'm done with it, but I haven't gone deep in the calculations.
Okay,
But at least I know
the
the
concept.
concept.
Yeah.
Okay.
So when I talk about deferred income approach for accounting for government grants, you can be able to follow.
Okay.
All right. Then this one here. This one is in section C, Stella. Which question is going to have this kind of work in section C?
Isn't it the one where they tell you to prepare financial statements?
Question 31 will be on financial statements, which can be for the single entity or for the group, not so consolidation, yeah. But question 32 is on ratio analysis, or what we call financial statement interpretation. You get where we talk about these ratios, yeah. I'm going to give you sufficient time to we are going to revise this section because it is very important, both consolidation, single entity, and also this, eh? But also what I can tell you, can you go to the revision pack and watch my discussions with the previous sittings, eh? On section B, section C questions, that is single entity, group, and then ratio analysis or financial statement interpretation, because there are already resources there, right? So when I
Okay.
meet you guys here to discuss, again, you just be consolidating on what you've covered from the revision pack.
Okay.
All right. So what would be your take on this one?
But Nanga, I failed.
You failed it. This is financial statement what? Financial statement interpretation, or what we call ratio analysis. Let us read through. In the year end 31st March 2026, Connect revalued its properties at year end for the first time. You see revaluation?
Yes.
Of course, once there is a revaluation, it means you either have a gain or loss. Not so?
Yes.
That is from IS 16. You can have a revaluation gain or a revaluation loss. And if you have a revaluation gain, it means you're going to have your statement of changes in equity is going to change. Is that correct? Because revaluation surplus or revaluation gain goes to what? Revaluation reserve and a statement of changes in equity. Correct?
Yes.
I'm trying to discuss the impact here. Once we have a revaluation, we shall take the revaluation, gain or revaluation surplus to revaluation reserve in the statement of changes in equity. What does it mean? Our equity is impacted. Is that correct, Stella? So equity is affected. Stella, are you getting the thought process?
Yes, I am.
The truth is, remember, if you have a revaluation surplus, the corresponding debit entry increases the value of the asset, right? The corresponding debit entry goes to the non-current what? Non-current asset. Is that correct? Please confirm you're following.
Okay.
Stella, are you following?
Kindly repeat that. I don't know, my network is on and off.
Yes, I said once there is a revaluation, do you know the double entry? What's the double entry? You debit the asset, not so, and then credit revaluation reserve, right? That revaluation reserve is in the statement of changes in equity, right? Meaning that equity is going to be affected, right?
Yes.
Okay. So the two accounts affected during the revaluation reserve are the non-current asset and what? The non-current asset, because the value will increase, and then the equity of the entity. Is that correct? Because you take the other revaluation reserve. So when it comes to the formula of getting current ratio, what is the formula? Do you know it?
No,
You've not done revision of this section,
not yet.
and it is question 32. So this is current assets divided by current liabilities. It is the easiest, right? It is the easiest. Now the question is, would a revaluation cause a change to current ratio? Because they are saying which of the following ratios would be distorted when comparing year-on-year performance and position of Connect. If this is the formula of getting current ratio, right? Would a revaluation have
Yes.
any impact on current assets? No. Is that correct? It will not affect, right? Because we've agreed it only affects equity. And what? It only affects equity and value of what? Non-current asset.
Non-current assets.
Because
Okay.
a revaluation increases the value of the non-current asset. And then the revaluation surplus goes to statement of changes in equity and a revaluation reserve. So it increases the equity, right? So anything that has Roman number 1 is wrong, because it will not have an impact on the current ratio, right? Meaning that now we can use elimination. This is the trick that I wanted to teach you. So A is off, right? Even B is off. You don't have to think about it, right?
Yes.
Now you come and ask yourself, what is the formula for getting asset turnover? Asset turnover is sales revenue, right? Divide by capital employed. Capital employed. That is the formula. Stella, are you following?
Yes, I am.
But the question is, what is the formula for getting capital employed? Okay? Because of course sales revenue is direct, right? But capital employed is equal to equity plus any interest bearing what? Any interest bearing debt, or what you call loan. Okay? Or loan. But we can also get alternatively, we can get capital employed. Please pay attention to this. Capital employed by getting our total assets. Total what? Assets. We remove, we less current liabilities. These are the two formulas for getting capital what? Capital employed. Are you getting it, Stella?
Yes.
Now from these two methods, I'm going to ask you, if I use equity plus interest bearing loans, okay, is capital employed being affected by this change?
Yes.
Yes, if I use this
Yeah,
one.
Yes.
Since it involves equity, and equity is going to be
Yes.
affected here, so capital employed is affected, right?
Yes.
So if this one is affected, capital employed, would asset turnover be affected?
Yes.
But also if I had used total assets less current liabilities, Would a revaluation have an impact on capital employed?
No.
Why not? What is this? Total what?
Okay, it's current plus non-current.
Yes, this would be current
Mm,
assets plus
okay.
non-current assets. So it would still be affecting, right?
Yes.
So using both methods, capital employed would be affected and therefore asset turnover would be affected. Meaning that 2 is correct, right? So we can't rule out 2 and what? We can't rule out 2. We can't rule out C and D.
D.
Since they both have what? They both have 2. Okay. What is the formula for getting gearing? Do you know it?
No.
Gearing is how heavy the business is indebted, right? How heavy the business is indebted. Remember, we have 2 forms of financing what? Of financing entities. It can be through equity financing or debt financing, right?
Yes. Yes.
So, the formula for gearing, for you to get the financing position of the entity, we get the debt owned by the entity divided by equity. As simple as that.
Okay.
You get?
Yes.
Gearing is how heavy the debt is, the company is indebted. So it is as easy as getting debt divided by equity. My question is, would gearing be affected by a revaluation position?
Yes.
Because there's an equity component here.
Yes.
Okay, so meaning that 2 was correct, so it is green. Even 3 is correct. So do you have to read number 4?
No.
That's how you can save time, yeah? Because C does not have Roman number 3 yet, you're saying it is correct. Then you come and mark what? And mark D. Clear?
Yes.
But maybe for learning purposes, how do we get return on capital employed? Do you know it? I'll give you homework, eh? But since it has capital employed, since it has what? Capital employed, and
Okay.
you already
Okay. I think I can try. Is it profit divided by the capital employed?
yes, and of course now you already know the formula for capital employed, eh?
Yes. Okay.
All right. Hey, please don't play with this. This is question 32. It is a full question on these things.
Yes.
So before I start revision of section C, make sure that you've gone through financial statement interpretation, both in the LMS classes and also the revision side, yeah?
Okay.
Because now I'll go to the details of how can we make use of this ratio analysis. What does it mean to have a different current ratio positions? What does it mean if asset turnover change and all of that?
Okay.
Chris, are you able to follow?
Yes, please, I'm not there.
Okay. So Stella, can you try out this one? Let me put it here. If there's any question, Stella, you can ask here.
Okay.
Can you try out this one?
Hold on. Number that's 7.
Yes, number 7, yes.
Comparability is identified in ISB's conceptual framework as enhancing qualitative characteristic. Which of the following will improve comparability?
Yeah, maybe
Recording actually.
before we discuss this, do you know that 2 forms of qualitative characteristics of financial statements from the conceptual framework? Do you know them?
Hello? I didn't get that.
Do you know that two types of qualitative factors?
Is it me? Hello? Can you guys hear me?
We can hear you. You mean you can't hear me? Is it your network? We can hear you very well. I think it was her network. Let us wait for her. We can wait for her. Daniel, at least, Chris, at least you can contribute here. Do you know that two types of characteristics, qualitative characteristics of financial statements? Yes, Stella, I think it was your network. Can you hear us now? Stella?
Yeah, yes, I can hear you.
Yes, the question was, we have two types of qualitative characteristics of financial statements. Do you know them?
Yes, I do. Is it relevancy?
When I say two types, I mean we have the fundamental
The fundamental,
and then the
okay.
enhancing, right?
Okay.
Yes, so under the fundamental, that's when we have
Relevancy,
and the fair presentation.
for representation.
Fair, right?
Yes.
Fair presentation. And then when it comes to enhancing, what do we have?
Comparability,
Comparability,
timeliness,
timeliness,
and understandability.
understandability. Okay, that's enough. At least you can remember them. Okay, so what is comparability about?
This is the ability of financials to show performance year to year.
Yes, you can be able to look at the performance of the entity this year and last year and you compare, right? Of course, when you
Yes.
have same accounting policies, you've not changed things, right? Same methodology.
Yes.
Then you can also have comparability between entities, but should be in the same industry, right?
Yes.
And you see that is the same analysis we shall make in section in question 32 when it comes to ratio analysis. Okay, so can you tell me which one would help to improve comparability out of those given?
It would be B.
It would be B, which is
Restating the prior earnings per share figure following a rights issue shares during the current year.
correct, because that would change the what? That would change the position, eh?
Yes.
Okay, but recording a transaction according to its substance rather than its legal form, of course, that would not change much, right? Including assets held for sale within property, plant, and equipment on the statement of financial position until sold. That is also, in fact, that is very wrong, right?
Yeah.
Then recording a change in accounting estimate in the current year's financial of course, with the accounting estimate, it is prospective, right?
Yes.
So it would not impact anything, so no need. But now, if you improve, if you restate prior number, it means you want to compare year on year the same performance. Nice.
Yeah.
Okay, we have 15 questions. We're just going to number 8. We should be able to finish at least section A. And let me hope you're getting some insights on how
Yes.
to approach. Okay. Have I copied the same thing? It seems. I'll go to number 9, right? Go to
Number 8.
Number 8.
Okay.
Let me
Still
see.
with relevance.
Oh, it is relevance. Yes, so I had copied the correct thing. And we've already talked about the relevance and all, right? So when it comes to relevancy, we talk about materiality. Would the decisions of the users be impacted, right?
Yes.
So relevance is, would it really influence the decisions of the users? Is the information material? So what would be the correct answer?
D.
Which is separately disclosing discontinued operations within financial? Yes.
Yes.
Because we're talking about, would the presentation affect the decisions of the users of the financial statements? And we agreed that if there is any discontinued operation, right, the users need to separately know that, okay, these are the results from the discontinued operations. If you do not separate, they might assume that the full performance is from the continuing business.
Yeah.
And so if they get to know that, okay, there are some results from discontinued operations, then they will be very bitter, because they would maybe they would change their investment decisions, basing on the performance of the entity after the discontinued operations. So this is very correct. Maybe Chris, this should be easy for you. Are you able to follow through?
Yes, please.
All right. We can go to number 9. I think Chris, you take us through this one. It is IAS2. IAS2. Are you able to take us through it?
Ivan, I'm going to read through them slow home this notice, please.
Okay.
Okay. On 31st March 2018, Agim's closing inventory was valued at its cost of 5 million, including some damaged goods. The damaged items cost $390,000 and are no longer expected to achieve their normal selling price, which is calculated to achieve a markup of 20%. These goods will have to be sold at a discount of 30% on the normal selling price. The value should be included from total inventory in Zing's statement of financial position as at 31st March 2018.
Okay. From IAS2. From IAS2. What is the guidance on the value of inventory? What is the requirement?
Of course, Ivan, I think we should first look at the text.
I didn't hear that.
I'm saying first look at the text.
I'm struggling to hear you. Chris, what did you say?
Ivan, I'm saying on this, I think we first look at what the cost.
Mm-hmm.
Because the total cost also includes some damaged goods.
Perfect. So what we have to do is, we have the total cost, that is fine, 5 million. But it has some damaged what? Goods. Meaning that we should be able to remove the value. Okay, we should be able to get, because if they are saying that the damaged items cost 390, right? Meaning that in the books, on this 5 million, there's this 390, right? But the question is this is this 390 the net realizable value of the damaged items? You get me?
Yes, please.
So you should be able to get the net realizable value of the damaged goods.
Yes.
Of course, when you look at total cost of inventory, it is 5 million. Not so? But can we remove the 390? The dollar what? Dollar 390. Just for running purposes. How much would it be?
Let's see here.
Yes, I'm seeing
The balance,
it is 4 million.
600 Jen.
4,061,000, right?
Yes.
This is the actual cost of inventory that is not damaged, right? Now, what is the cost of damaged goods? How much is it? 390. Is that correct?
Yes.
But we should record it at the lower of cost and NRV. Is that correct? So now the question is, what is the net realizable value? Net realizable value of damaged what? Damaged goods.
Yes. Okay.
So once we get to that figure, then we can come and add it here. So that now our total, maybe I can put here to give you total actual value of inventory should be the goods, or I can call it undamaged, damaged goods plus net realizable value of damaged goods. And of course the goods, this is the total cost of undamaged inventory. Is that correct? Now,
Yes.
okay, so how do we get the NRV of damaged goods? Would get the cost. Not so they are telling us that are no longer expected to achieve their normal selling price, which is calculated to achieve a markup of 20%. So maybe I can use a table here. Insert. I can have my workings. Okay, something like this. Okay, so here we have the cost of damaged goods. Cost of damaged goods. Maybe for you to remember, how do you get NRV? Is it the selling price less cost to sell? This is 390, right? But we need to add what? First, to get the normal selling price, we need to add the markup. Is that correct? Because we've agreed, we are saying NRV for revision purposes. NRV equals selling price. Still, are you following? Selling price.
Yes.
It is selling. Okay, selling price less cost to sell. Is that correct? Less cost to sell. So this is our cost. We need to get the selling price, so we have to add markup. We need to get a markup to give you the profit. So they told us that markup is 20%. So how would we get the amount? If markup is 20%, what would be the profit now? That should be times 20%, right? So it should be 20%. This is at 20% of the 390. How much do you get?
I think it's 120% of 390 now.
That would give you that selling price. You get it? You do that, you get the selling price. If you do that, selling, you get 120 of 390. You should get the selling price that we shall get here. How much do you get?
Okay. 468.
468, yeah? 468. And that is the total.
Thousand.
That is the total of getting. What is 20% of 390?
8,
It is
8,000.
78,000. So, Stella, since
Yes.
if it was not for the running purposes, since this is an M, since it's a section N number, you would have gotten 120 times 390. You get your selling price direct, right? That
Yes.
would make sense. Then what is the cost? What is the cost? What is the cost to sell from this question? Are you able to see it? You're discounting, eh? Of course, a discount is an expense. It is a cost, right? Stella, do you get that? Do you pick that?
Yes, I do.
Less cost to sell. And this time around, it is our discount. It's our discount of 30%. Eh? So what is 30% of the 468? How much do you get?
140, 400.
140, 400. So what is now the net realizable value? Our NRV, which is selling price, less cost to sell.
327, 600.
We get 327, 600. Now this is the net realizable value, right?
Evan, meaning so it's the same thing as me saying 70% of 768.
Yes, it is 70% of the 468. Seems, did you do math?
Yes.
Most of the accounting students have failed these things. But that's just basic math, eh? It is 70% of the 468 to give you the 327. But now from IAS2, we say that the value of inventory is the lower of what?
The cost.
Of NRV. Yes, lower of cost and NRV. And what is that value? Cost is 390, NRV is 327. So it should be 327, yeah? 327. Chris, are you able to follow? Meaning that now our total value of goods, I'll pick it and put it here, should be how much was that? 3.6, eh? 3.6 million.
4.6.
Sorry, 4.6 plus the dollar 327, 600. How much do you get?
$4,937,600.
4,937,600.
37,600.
And which option is that?
A.
Option A. But also, Stella,
Yes.
from someone with math background, when you get the 327, maybe net deductible value. I'm just giving this as an alternative. Alternatively, you would get the remember these guys had included 390 in the books, right?
Yes.
But the actual value is
327.
327, So what is the difference?
6 to 400.
6 to 400, meaning that inventory of 5 million is overstated by this amount, right?
Yes.
So which is inventory is overstated. So for you to get the actual amount, so actual inventory value would be the 5 million minus the overstatement. How much is the overstatement? 42,
Okay.
62, 400. Yeah, and in accounts that this will be the viable option, yeah? So how much do you get?
Okay. 4,937,600.
Yeah, in accounts this will be the viable option because you'll be required to pass an adjusting entry, yeah? So meaning that in your books you would pass an adjusting entry of 62,400. So now inventory becomes this value. Does it make sense?
Yes.
Yeah, so for a student who is very good with math, you maintain this as your inventory value, come and compute your NRV, get the difference between NRV and cost, remove it from your value. Then you can pass the adjustment in the accounts of 62,400. Chris, any question for me?
Because Ivan, in this revision sessions, they also recorded
Yes.
in the past.
Yes, I told you. Do you know what we call the revision pack? Have you looked at it?
Yes, I'm going to a little bit.
Yes, the revision pack has the recordings for these discussions.
It will be of use.
Yeah, and you see, Stella,
Yes.
what I'm discussing now, I didn't discuss it all the previous sittings because I keep discussing different questions. So you see that you're learning so much from these discussions,
Yes, I am.
but there is a lot you learned from the previous discussions as well for the other sittings.
Okay.
So that's why you should also watch.
I'll go through them over the weekend.
Yeah, maybe you can do a times too, but at least you get the concepts.
Yeah. Yeah.
All right. Okay, so we have 5 questions to go. We are now on question 10. Not bad. Not bad, not bad. Okay, so this is question 10. This one is on lease agreement IFRS 16.
16.
Do you want to try it out?
Okay. Right. On 1st April 2008, Daniel acquired a machine via lease agreement and paid 45,000 immediately, being the first 5 equal annual rentals in advance. The PV
Okay,
of the
now
remaining.
this is very important. He paid 450, right? And is going to
Yes.
pay in advance, not in arrears. And meaning that this is not a down payment.
No.
Okay. Continue.
The present value of the lease of the remaining lease payments as at April 1st April 2008 was 155,000.
So
The lease has
no, we need to appreciate. Remember, when it comes to IFRS 16, we have the right of use asset. What else? And the lease liability.
Yes.
And of course, the lease liability is the present value of the future payments, right?
Yes.
Perfect. And what increases the right of use asset? Of course, the right of use asset would be affected by the depreciation, not so? And then also the lease liability would be impacted by the unwinding of interest, right? Or what we call the finance cost, right?
Yes.
Okay.
Yeah.
So,
Interest.
can you continue?
The lease has an implicit interest rate of 10%.
Perfect.
and the machine useful life for 5 years.
Mm.
What amount in total is charged to Daniel's P&L for the year ended 31st March 2009 in respect of the above lease?
Mm. We know that
So
charge to P&L can be in form of depreciation, right?
yes,
And what? And the finance cost.
finance cost.
So we just have to compute those two.
Okay. So to get the depreciation,
Mm.
we first did the right of use
You need the right of use asset. And remember
and
how
the
to get right
present.
of use asset.
This question it was given, I think.
Hmm?
This question it was given. No?
Are you sure? Where is it? I don't see it.
Isn't it the
Via.
45?
Is it the 40?
Isn't it the 45?
Remember, right of use asset equals the lease liability plus any payments, okay, made before lease commencement. Is that correct? So these guys paid the 40. Of course, the lease liability is 155, right?
Yes.
Plus the 45 that was paid. Is that correct?
Yes.
To give you how much?
200,000.
200k. Please, you have to be very sober with how do we compute right of use asset. It is always the lease liability plus any down payments, and then the lease liability is the present value of the future payments.
Yes.
So what would be our depreciation?
You divide that 200 by the useful life, which is the 5 years.
And we get
40,000.
40k. Okay. So how do we get the finance cost? Finance cost is always what? Finance cost is the outstanding liability times interest, right? So our outstanding liability is the 155. Is that correct?
Yes.
You get me?
Yes.
So it would be dollar 155, because that is the outstanding lease liability times the 10%.
10%.
How much do you get?
15,500.
Get the 15,500. Is this clear? How we compute the finance cost?
Yes.
So what would be now our charge to P&L?
You would add the depreciation plus the finance cost.
Of how much? 15,500. So how much do you get?
55,500.
55,500. And it is option what?
C.
It is option C. Chris, are you able to follow? Any question for me? So, okay.
Can they bring something like this, like in a question in section B?
Yes, they can. Very well. Is it hard? I think it is easy. It is direct.
No, it's like you almost
Mm,
can't say, okay, apart from section C, whereby maybe there are standard questions, standard topics.
mm.
It's like you almost can't say these ones are like section A, section B.
No. For section A, in fact, apart from section C, section B,
Yeah.
anything can come.
Yeah.
Section A, anything can come. Full syllabus. It is only section C where you know question 31 is it preparation of financial statements. So I should prepare for single entity, I should prepare for consolidation, right? Then question 32, it is ratio analysis or financial statements interpretation. That one you're sure, but for section A and B you're not sure. Aligned?
Yes.
Okay, we can go to question 11. We should be able to finish up section A. And you'll see that most of our discussions, I'm going to focus them for section C. Because for section A and B, so long as you've done sufficient revision on all standards, you can be able to pass. But for section C, we need to focus on those two questions, which of course carry more marks. Okay. Chris, you want to try this out, or we'll give it to Stella? Okay, Stella, you can give it a shot.
Okay, at 1st April 2008, Swizzle had property in its financial statements that originally had a cost of 27.5 million. Being land was 2.5 million and buildings was 25 million.
When you see this breakdown, what
And-
comes to your mind?
Car.
Of course, you can't depreciate land, right?
No.
And now had accumulated buildings of this. So this 10%, this 10 million should go to the buildings, only, not to land.
Yes.
That's why they are giving you that breakdown. But also when it comes to appreciation, for revaluation, will you talk about buildings revaluing?
No, land.
That would be now to land, So that is the concept.
Yes.
Proceed.
On 1st April 2008, the directors decided to revalue the land and buildings for the first time and accepted the report of an independent surveyor who valued the land at 4 million and the buildings at 19.5 on that date.
In fact, even building can be revalued. I don't know why you said. Remember, value of building will depend on the location of the land. Do you appreciate that? Yes, we can revalue buildings.
Really?
Yes. Do you think a flat in Muyenga value is the same as a flat in Mukono?
No.
Location,
But isn't it because of where the land on which they are seated?
Meaning that it is the value of the plot that also gives the value to the building. The same thing for a building in a swamp and a building on a hill. Do you think they would have the same value?
No.
Of course, land in what is this place here? In Iwaise. The house in Iwaise is more cheaper than the one this side of Chiwatre or what, right?
Yeah.
So these guys made a revaluation and land was now at 4, whereas building was at 19, right?
Yes.
Now land moved from 2.5 to 4. But building, which had 25, was affected by the you can't compare 25 and 19. Are they comparable?
No.
Because the 25 still has what? Some depreciation.
Depreciation.
So it would be now, this is 15 and 19. You get?
Oh, yes.
You can continue.
Okay, so the remaining useful life as at April 2008 was 15 years. Sorry. What will be the amount of depreciation charged to the P&L for the year ended 31st March 2009?
In fact, we read these things for nothing. Do you know why? The question is on what? On depreciation, right?
Yes.
And remember, now you see, now this is a question for you to save time. If you do a revaluation, what is going to be now the carrying amount of the asset?
The new amount.
The new amount, right?
Yes.
So mean that just that what you needed was to understand the question, come and pick this 19, divide by 15, get your answer, and
Divide by
continue.
15. Yeah.
No need of looking at land, what you get, eh? But
Yeah.
for learning purposes, of course. So of course the carrying amount of building, because it's down that would undergo depreciation, eh? After revaluation be the 19.5 million. So depreciation would take effect from that 19.5 m by 15, eh?
Yes.
How much do you get?
1.3.
1.3. So this was a question for you to save time. Did you get it right in your...
Yes.
Nice. Okay, I think you can go to number 12. We are almost there. Number 12. Chris, are you able to follow?
Yes, Evan, I'm following.
Okay, so this is 13. And this is IAS 36 impairment. Should be very easy. Can you take us through?
Okay. IAS 36 impairment outlines indicators of when an entity's assets may have become impaired. Which of the following are not internal factors of impairment? The asset's market value has declined. The asset market value has declined more than would be expected from the passage of time.
The question is
Which are not internal.
internal. Remember, this market value, asset market value, is it internal or external?
Asset market value.
This is external, eh?
External.
Of course, internal is any benefit from the asset, yeah?
Yes.
So this one is external. Now we can use elimination, right? Anything with 1 is off, yeah? So these ones are off, right? You get? That is the idea, because if you're ruling out asset value, since it is external, so anything having that should be off. Now you focus on A and what?
On A and D.
And D. So can we read number 2?
Damage to or obsolescence of the asset. Yes.
Now do we need to waste our time? Number 2 is correct. Not so?
Yes.
Meaning that its answer is what?
D.
That's how you save time. So you don't read option 3 and 4 by elimination, eh?
I got it wrong. I considered I said
But
1
Evan,
and
but,
3.
Yes?
Which of the following are not?
but Evan, they're saying
Yeah, but they are saying which
which
are
of the
not
following are not
internal.
internal
Yes.
indicators of impairment?
Yes.
Not
Yes.
internal.
Yes, which
Yes.
are not internal, right? Not internal.
Yes.
So
That means I is not internal,
so
it's
I
external.
is external.
So the answer, we should consider things with I. You get?
You remove... wait, let me see. Which of the following are
Yeah.
not internal?
Are not internal indicators of impairment.
So I got it the other way around. Sorry.
Okay, so
Mean that it should be A and D should be off, eh?
I think
A and D should be off, right? Then we have B and C.
I and triple I.
Yes, give me 1 second.
Yeah.
Okay,
I
since
think
it
it's
is not internal,
C.
so we should have B and C. Thank you. And so since damage to or obsolescence of assets is internal, then it becomes also an eliminating what?
Yeah.
An eliminating factor. Thank you. So this one is this one is extra. This one is off. So we can put this as green, since they want the external ones. External ones. So since 2 is correct, then no, since 2 is wrong, then B
Two is
becomes
wrong
wrong.
and okay, it is C.
C.
So B becomes wrong, right?
Yes.
And
Yeah.
so C passes. I think we are taking the other way round. Okay, nice.
Yes.
Of course, change in economic environment is known, that is external,
Yes.
Yeah.
and then changes in the way the asset is used by the end, this is internal, purely internal. Okay, so how did you get it wrong, Stella?
I got it correct. If you had considered B, I would have gotten it wrong.
Eh,
C.
yeah, I think it's me who had interchanged the interpretation. So this is number, is it 14? This was 12, right? Let me check.
Yeah.
Okay, so this one is 12. I should be tired for sure. This is 12. Now this one is 13. So can you tell us through this, Stella?
Okay. Which of the following is not true concerning the treatment of borrowing costs under IAS 23? So A, only borrowing costs on a qualifying asset can be capitalized.
So not true, yeah? So is it true?
Not true. Not true.
Yeah?
It's
Not
true.
true.
It is
True.
true.
It's true.
Only.
We only capitalize qualifying assets, yeah?
Yes.
That is
Costs on qualifying
the
assets.
asset on which the loan was what? Was obtained, eh?
It's true.
So that one is okay.
Then capitalization of borrowing costs should be suspended if construction is suspended for an extended period. Yes, that's true.
Yes, that if you have any issues during the process, why is this thing now becoming a problem? Okay. Then number C.
Borrowing costs can continue to be capitalized once activities to prepare for the asset once the activities to prepare the asset for use are complete if the asset is not yet in use. Not true.
Yeah.
You
Once
only stop
you do what?
borrowing costs can continue. You only stop capitalization once the asset is ready for use.
Yes. Even if it's not in use, but as long as it is
Yes.
ready for use, then you stop, eh?
Stop. Yes.
So that should be the correct answer, right?
Yeah.
Borrowing costs capitalized are net of any temporary investment income from the funds borrowed. That is correct. That if you borrow 20 million and then invest it and it earns you 5 million, you net off.
Yeah.
Okay, that we should be aligned. 14. This is on impairment. Can you run through that very fast, Stella?
That one I didn't get it.
You didn't get it, you failed it. Okay. Impairment should not be very hard. We can run through. The balance on all development expenditure as at 31st March was 16. Original cost 20, right?
Yes.
Estimated dip 4. The development costs relate to a product called Stone, which was being amortized over 5 what? Over 5 years. So this is a research and development, yeah? A review of the sales of the Stone in late March showed them to be below forecast. An impairment test concluded that the fair value of the development expenditure was only 9. and stone was only expected to sell for a further 2 years. Now this is from they want us to evaluate based on the units of the value of units. Okay, so they are giving us the carrying amount. Maybe I will use the table. What amount will be charged to P&L in respect of the impairment of the development expenditure for the year ended? Okay, so they want us to get the impairment charge. Of course, how do we get impairment? Loss? Do you know how we get it? Impairment loss. Okay, when is an asset impaired? When the carrying amount is what?
Greater than the recoverable
amount. An asset is impaired if the carrying amount is greater than the recoverable what?
amount.
Greater than the recoverable amount. The question is, now the question comes on the recoverable amount. How do we get the recoverable amount? Recoverable amount is what? Is higher of value in use, not so? Value in use and fair value less cost what? Cost to sell. Is that correct? So the question is, what is our fair value? Do we have value in use? Present value.
Your fair value is 9 million.
So we only have the fair value, right? We don't
Yeah.
have the value in use. So our recoverable amount would be the fair value, right?
Yes.
So the recoverable amount, you see that would be the thought process, would be equal to the fair what? Fair value, which is what?
9 million.
9 million. What is our carrying amount? Our
16 million.
carrying amount now. The question, are you sure it is 16 million? I doubt.
It is.
They told us that at 31st March 2x8, the balance was 16, not so? But we are dealing with 2x9. So that is 1 year down the road, right? So you have to amortize that asset again. So our carrying amount, that is at 31st March 2x8 was 16 million. Now when it comes to amortization for the year, since this is an IS38 asset, so we use amortization. Amortization for the year, it would be let me see, where is the useful life? Do we have it?
Yeah, 5 years.
Where is that 5 years? I'm looking for it. Balance on development expenditure as at this was this 16 million.
Next line.
Original cost is this. Accumulated is this.
The development
Development cost related
cost.
to product which was amortized over 5. Development cost related to a product called stone which was amortized over 5. But remember now, you see, this one here is over 5 years. So what is going to be our depreciation for our amortization for the year? Which value are we going to use?
The 20 million.
Yes. You can't use 16 because 16 is just carrying what? Carrying amount. So this, the dip of okay, so this, what is annual amortization? How much is that? Is it 4? 4 million, eh? Is that correct? Now, what is the carrying amount at 31st March 2x9? How much is it? Is it 12 million, Stella?
Yes.
And what is our recoverable amount? Our recoverable amount was what? It was 9, yeah?
Yes.
And of course, impairment is carrying amount, since it is higher, minus recoverable amount. So what is our impairment? Stella, what is our impairment?
Carrying amount is greater than the. Oh, is 12 million?
Impairment loss would be the carrying amount minus recoverable amount. So how much is it?
Oh, just a minute. So 12 minus 9. That's 3 million.
3 million. And that is option B. So what confused you?
No, just no. Oh, I got over 7.
Do you have your workings to know where you got it wrong from?
First of all, I depreciated 16.
This is carrying amount.
Instead of the 20 million.
Maybe that's why the issue is. What they told us was being amortized over 5 years, which should be the
Yes.
original cost divided by 5.
Yeah.
Can go to the last question to conclude section A. So that we can earn our 30 marks. Chris, can you try out this question? Question 15. This should be on IAS what? IAS 10. Events after reporting period. Have you covered it already?
Yes.
Okay, seems Chris is mute. Can you bail us out? Can you bail us
Am
out
I
to
ready?
understand? Yes, Chris.
Okay. I think the Jim is an entity to prepare these financial statements for the year ended 31st March 2019. On 24th April 2019, prior to the authorization of the financial statements, the Internal Audit Department discovered a fraud by an employee who had been making payments to its supplier during the year to 31st March 2019. Investigation showed that the total amount of the fraud amounted to $790,000, which is considered to be material. The keyword is material here. Then, how should the fraud be treated in the financial statements for the year ending 31st March 2019 in accordance with IS 10 Events After Reporting Date?
Are you seeing what I'm adding?
Yes.
If you remember my discussions on fraud during IS 10 topic, I told you fraud. We have materiality by nature and materiality by
Yes.
amount. Okay.
Yes.
Fraud is material by nature, regardless of the amount. So
Yes.
this statement shouldn't put you off. It is already fraud. It is material by nature, and so the amount does not matter, right?
Yes.
And since this is an event after reporting period, of course fraud should be an adjusting event, right? Remember, we have two options. We have non-adjusting and adjusting, right?
Yes.
But since this is an indicator that this the audit happened or the fraud happened before the year end, right?
Yes.
and so it should be an adjusting event. So what is the correct answer? Chris, is it a non-adjusting event?
I think
Yes?
yes, Taylor.
We can't hear you, Chris.
I'm saying
It's
that.
D.
I'm saying that. I'm not sure it was D.
Yes,
I don't know.
the answer is D. It is an adjusting what? Event.
Event.
First of
Okay, is it because it happened within the period? Or?
no, from the discussions,
It
let
happened
me
after.
show you. You know, IS10 deals with events after reporting period.
After. Yes, so I thought adjusting
Mm.
are those ones that happen during the reporting period, but you notice them after.
Yes, that is correct. You see, okay. The year end is
Stop the
31st.
question a bit.
Year end is 31st March 2x9, right?
Yeah, yeah.
But you know there is the period between year end and the date of authorization, right?
Mm.
You get me?
Yes,
So
yes.
let me just try to draw something here for you to get it well. So we have here year end, Control V. Then we have here date of authorization, right? But in between we have an event happening. So I would take I would insert here, put something somewhere here. So this is year end, which is 31st March, 31st March 2x9. Let us assume these guys, of course it is always 3 months here. Always 3 months after year end that you must have your financials released, right? So this can be around what? March. You have April, May and June. So 30th June we expect these guys to have signed, right? 30th June. We expect them to have what? To have signed. So this is the period between events after reporting. This is the period between after reporting period, right? That is between 31st March 2x9 and 30th June. You get me? So anything that happens in between here can be adjusting or non-adjusting. Do you get it, Stella?
Yes.
So what is happening is on 20 what? On 20 on 24th of April, an event after reporting date happens. And what is that event? It is fraud, right?
Fraud.
It is fraud. Here, fraud case. Meaning that it qualifies to be an event after reporting period. But the question is, did this really exist before 31st March or it happened after 31st March?
Okay, because they say that
Mm.
I've been making payments to a supplier during the year
Yeah.
31st March.
Mean that now the occurrence of the fraud was from this side. So fraud happened this
Yes,
side, you get? Let me
yes.
put something here. So this fraud happened here, but only discovered after what? After year end. So if there are good systems here, they would have identified this fraud before the year end. Fraud happening, but not. but not identified, right?
Yes.
Now here fraud identified. So it becomes an adjusting event because it existed before year end but only realized after year end and before the sign off.
Okay.
So anything that happens after sign off, it doesn't fall under IS 10.
Yeah.
So is it clear now?
Yes.
That's why now it is an adjusting event. Hopefully you got it correct.
No, I put A.
You consider it non-adjusting. Okay. If you had put,
Yeah.
assuming it was a fire that happened on this date, what would happen? Would it be an adjusting event? If it is fire that happened here, would it be an adjusting event?
Yes, because you have no control over it.
Chris, what would be your take on that? Assuming fire happened on this date. Same timing.
I think it will be also an adjusting.
Yes, so if this is fire, Stella,
Yes.
fire gutting your warehouse, okay? Is it
Yes.
something that happened before the year end?
No, it happened after.
Fire happens. So this one happens after, right? So it is a non-adjusting.
No.
Do you get the difference? This one is adjusting.
Yeah. Okay.
Because fire is going to be a one-off thing and a fraud happened before. All right. Hopefully the discussions have been beneficial. Let us meet next time. I think I'll be marking your section B and share the results.
Okay.
All right. Let me share
Thank
this
you.
Word
Good
document
night.
as well. Good night.
Okay.
Thank you.
Good night.